All right, so let's be honest. The markets, they've been pretty wild lately,
Yeah.
especially if you're, holding tech stocks or Bitcoin.
Hmm.
It can feel like you're on a roller coaster that you really didn't sign up for.
Mm.
But that's okay because we're going to break it all down today and try to understand it.
Yeah.
We've got this really interesting chapter from the book Crises de marché, Opportunités et stratégies pour investisseurs avisés.
Okay.
It's French, and basically it means market crises, opportunities, and strategies for smart investors.
Gotcha.
And what we're going to do is we're going to try to learn how market downturns, which seem so scary,
Right.
can actually be good for savvy investors,
Yeah.
especially for those of us who are in it for the long term.
Yeah, you hit the nail on the head of that, the long haul part.
Oh, thanks.
It seems so simple, but that shift in thinking is huge, and a lot of investors miss it.
Yeah, totally. And you know what? The source dives right into this idea that market crises actually equal opportunity, which sounds a little bit crazy at first, especially when you're looking at your portfolio and you see all the red.
Exactly.
But it does make you think, like, is there a time in history where this has been really true, like a good example?
Oh, for sure. Tons of them.
Hmm.
I mean, take the 2008 financial crisis, for example.
Right.
I mean, scary time, absolutely no question. But while everyone was, running around in a panic,
Yeah.
companies like Apple and Amazon, they were quietly getting ready to, kind of take over the world.
Wow.
While so many investors were busy selling off, everything. They had the people who saw the long-term potential, who understood these companies, like what their strategy was, how strong they were.
Yeah.
Those investors got huge rewards in the years after that.
So they were buying when everyone else was selling.
Yeah, basically they got to buy shares for way less than what they would be worth later on.
Okay, that makes a lot of sense. But it also reminds me of that buy the dip saying that everyone loves to throw around these days.
Right.
But our source doesn't seem to be a big fan of that approach, does it?
No, not really. I mean, there's a big difference between, smart investing in good companies when their prices are down for a bit and just buying anything that's lost value.
Like blindly buying.
Exactly. The source actually talks about this mistake that a lot of investors
Mhm.
make. They focus so much on the sale price that they forget to even check if the company's worth buying.
Oh yeah, I've done that. I've totally been there.
Yeah.
I remember one time I saw the stock just plummeting and I just jumped right in
Oh.
without even knowing what the company did.
Oh.
And yeah, I learned my lesson the hard way.
Well, it happens, but the important thing is to understand the company's fundamentals, like their financials, their leadership, their competitive edge, all that.
Yeah.
Especially important when the market's being crazy like this.
So you're saying it's like building a house, right?
Exactly.
You wouldn't just buy the cheapest bricks without even checking if they're, good quality?
No way a shaky foundation means a shaky house.
So true. Okay, so let's talk about what's shaking up the market right now. What's going on? The source points to a few different factors.
Yeah, it's like a perfect storm of, global uncertainty, inflation worries,
Hmm.
and people are still scared of a recession.
Yeah.
And then you throw in some, geopolitical stuff, and yeah, it's no wonder the market's freaking out a little.
Yeah. And we've seen that some sectors like tech and cryptocurrency are getting hit harder than others.
That's right.
Why is that? Why are they taking the brunt of it?
Well, tech stocks, especially those high growth, high valuation companies, they're really sensitive to interest rate hikes.
Okay.
So when rates go up, borrowing money gets more expensive, and that can hurt their future earnings and make investors less interested.
Makes sense.
And cryptocurrency, well, it's still pretty new,
Yeah.
and it tends to overreact to any sign of, economic trouble.
It's like super sensitive.
Yeah, it's kind of like the canary in the coal mine.
Oh,
It
interesting.
often shows us what the broader market is feeling.
Okay, so it's all connected.
Yeah.
So it sounds like trying to guess when this downturn will end is kind of pointless.
It really is. The source makes that point very clear.
Yeah.
It's like trying to predict the weather. You can make educated guesses, but you can never be totally sure.
Right.
And the source uses Palantir as an example. Their stock took almost 2 years to hit its lowest point after a big drop.
Yeah, I remember that one.
So anyone who thought they were being clever, trying to time the market and get in early, probably ended up losing money.
Wow.
The lesson there is patience and a long-term view are really important.
Okay, I'm starting to see why that buy the dip thing isn't the magic solution everyone thinks it is. So if timing the market is a no-go, what does the source say we should do to handle this choppy market?
Well, the source is all about being proactive in managing risk.
Okay.
It's like you wouldn't wait until your house is on fire to install a smoke detector, right?
Definitely not.
So what's the smoke detector for our investments?
Okay, I like that analogy.
The source suggests something I find pretty smart. Gradually reducing your stock exposure when markets are peaking. It might seem counterintuitive when everyone's feeling good, but it's about protecting what you've gained and minimizing potential losses when a correction happens, because it always happens.
So instead of riding the wave all the way up and crashing down, we kind of strategically hop off before it crests.
Exactly. You're not trying to perfectly time the market. You're just reducing your risk.
Okay.
The source says think about selling a portion of what you own, maybe 10% to 30%, when the market hits those record highs.
Okay.
This way you lock in some profits and you have cash ready if things take a downturn.
Makes sense. It's like taking some chips off the table in poker while you're ahead so you don't lose everything in one bad hand.
Exactly.
But I imagine that takes a lot of discipline.
It does. It's easy to get caught up in the excitement when the market's doing well. But remember, what goes up must come down. Having a plan, even when things are good, can help you stay grounded and make rational decisions.
Yeah, that's good advice.
And that's where having that long-term perspective is so important. The source says that investors with a 5 to 10-year horizon, they're not really bothered by these short-term swings.
Right. It's like zooming out on a graph. You know, those daily little dips and spikes, you can barely even see them when you're looking at the big picture.
Exactly. If you're not planning on touching that money for a few years, the daily ups and downs don't matter that much.
So being patient is key, especially now. The source even talks about having liquid assets, ready to go when prices drop. Why is that so important?
Well, think of it like having ammo ready to fire. When the market gives you a chance to buy something good, it's about being prepared to jump on those moments when fear pushes prices down, and suddenly you can get those quality assets at a discount.
So it's not just about sitting on cash. We're strategically waiting with it for the right time to use it.
That's it.
And this kind of goes hand in hand with that incremental investing idea that the source talks about, right?
You got incremental investing is a really powerful way to lower risk and possibly get better returns over time instead of throwing all your money in at once. You spread it out over a period of time.
And the source specifically mentions dollar cost averaging as a way to do this.
Right. Dollar cost averaging, it's a popular way to do incremental investing, and it's pretty simple. You invest a set amount of money regularly, no matter what the market's doing.
So up, down, sideways, it doesn't matter.
Exactly. You stick to the plan.
I've always liked dollar cost averaging because it feels less scary than trying to time the market perfectly. But I've also heard people say it's not always the best because you might miss out on big gains in a bull market if you're only putting in a little bit at a time. What are your thoughts on that?
Well, yeah, that's true. Dollar cost averaging might not do as well as investing a lump sum all at once when the market's going up really fast, but it does protect you from those big drops. It's about deciding what's more important to you. Weighing the risks and rewards and figuring out what fits your goals and how much risk you're comfortable with.
It's like there's no one right answer.
Exactly what works for one person might not work for another.
And that brings us to something else. The source talks about the danger of emotional investing.
Oh, yeah?
I think we all struggle with that a little. Even if you've been investing for a while, when you see those red arrows, it's like your gut takes over and you start making decisions based on fear instead of logic.
It's true. Early on in my investing days, I definitely fell into those emotional traps. I remember this one time I had invested in this tech startup that was doing really well,
Okay.
and then all of a sudden this negative news article came out, and the stock price just tanked.
Oh, no.
I totally panicked and sold everything at a big loss. What I didn't realize was that the article was just speculation, and the company was still doing fine.
Oh, wow.
A few months later, the stock recovered and went even higher. I learned a big lesson that day. Don't let fear control your investment choices.
It's so easy to get caught up in the moment.
It is.
That's a good reminder that it's not just about understanding the market, but also about understanding ourselves, our own emotions.
Absolutely. The source really pushes for a disciplined approach to investing, making decisions based on good research and knowing your goals, not letting fear or greed take over.
So we have to be our own emotional coaches when it comes to investing.
Kind of. Having a plan, sticking to it, not letting the market noise distract you, it's all really important.
The source also warns about jumping into the market without a plan and about using too much leverage. What exactly is leverage and why is it so risky, especially when the market's down?
So leverage, it's basically borrowing money to try and get bigger returns. It can be really powerful if you use it the right way, but it can also make you lose a lot more if the market goes against you. It's like using a megaphone.
Oh, I like
It
that.
makes everything louder, the good and the bad.
So high risk, high reward.
Yeah, and during a downturn when prices are dropping, leverage can wipe you out if you're not careful. The source says use leverage carefully if you use it at all, and really think about what could go wrong.
It's like walking a tightrope. You need to be balanced and have a safety net just in case.
Right.
So if we're tying all this together, it sounds like the source is saying be informed, be patient, be strategic, especially when the market's having a tough time.
You got it. It's about understanding that market ups and downs are normal and seeing them as opportunities, not threats.
So what can our listeners do right now to manage risk and maybe even make some gains in this market?
Well, first things first, take a look at your investment goals and how much risk you're okay with. Have those changed since the market started acting up? Once you're clear on that, you can start adjusting your portfolio.
It's like checking your map before you start a road trip.
Yeah, you need to know where you're going and how bumpy the road might be.
And if you're feeling nervous about all the volatility, maybe think about slowly reducing how much you have in those riskier assets like tech stocks or crypto. It doesn't mean selling everything, just maybe trimming things down to a level you're more comfortable with.
That's the idea. Find that balance between staying invested and protecting yourself from losses.
And diversification is always a good thing, right? Don't put all your eggs in one basket.
Absolutely. Spread your investments around stocks, bonds, real estate, maybe even some alternative things like gold or commodities.
It's like building a diverse team. You want people with different skills to balance each other out.
Exactly. And don't forget about cash. Having some liquid assets gives you options when those opportunities pop up.
So we're not hoarding cash. We're strategically holding on to it, waiting for the right moment.
That's right.
What about dollar cost averaging? Is that a good idea now?
I think so. Dollar cost averaging can work really well when the market's uncertain because you're basically using those price swings to your advantage when prices are low. You buy more shares when prices are high, you buy less, and it evens out your average purchase price over time.
It's like a built-in shock absorber for your portfolio.
Exactly. It helps you take the emotion out of investing and just follow the plan even when things are crazy.
This all makes sense, but what about fundamentals? Where do they fit in?
Oh, great point. Fundamentals are always important, but even more so in a downturn when fear is running the show. You got to remember that not all companies are the same. Some are just better at handling tough times than others.
So how do you figure out if a company has good fundamentals? Where do you even start?
Well, there are a few key things to look at. First, check out their financial statements, their income statement, balance sheet, cash flow statement. Those will tell you about their revenue growth, profitability, debt levels, cash flow, all that good stuff.
So we're doing some detective work looking for clues.
Exactly.
What are some red flags to watch out for?
Well, if you see their revenue dropping or their profit margin shrinking, that could be a bad sign. A high debt-to-equity ratio might mean they're borrowing too much, which makes them vulnerable to economic shocks. And you definitely want to look at their cash flow. Is it positive or negative?
Yeah.
Positive flow means they're making more money than they're spending, which is a good sign.
So we want companies with strong financial foundations that can handle the pressure.
For sure. And you also want to look at who they're competing with. Do they have a strong position in the market? Are they a leader in their industry? Do they have something that gives them a real edge over the competition? Those are all signs that they're likely to do well in the long run.
So even in a downturn, we're not just looking for a cheap deal. We're looking for quality companies with a good track record and a bright future.
Exactly. And don't forget about the less tangible stuff like the management team. Are they experienced? Do they have a vision? Are they making smart choices?
So we're looking for companies that are built to last even when things get tough. Yeah, it's like we're putting together a puzzle, looking at all the different pieces, the financials, the market position, the management team, and trying to see the whole picture of the company's potential.
Yeah, that's a great way to think about it. It's about seeing the big picture, not just getting stuck on one little detail.
This has been so helpful. I feel like I'm starting to understand market downturns in a totally new way. It's not just about hiding and waiting for it to be over. It's about being proactive and smart and even using it to your advantage.
That's the right attitude. Remember, even the best investors lose money. Sometimes it's just part of the game. The important thing is to learn from those times, adjust your strategy, and keep going.
So it's not about never losing. It's about managing those losses and learning from them.
Exactly. And one of the best tools you have is knowledge. The more you know about the market, the better you'll be able to handle those ups and downs.
Knowledge is power, for sure, but sometimes it can feel overwhelming with so much information out there. How do you stay informed without getting lost in it all?
That's a good question. I would say focus on quality over quantity. You don't need to read every article and report out there. Find a few sources that you really trust and that give you good insights, whether it's a financial publication, a podcast, or a respected analyst. Build your own information stream so you're getting a balanced view.
Like creating your own personalized news feed for investing.
Exactly. And don't be afraid to look for different opinions. Read things that challenge your own ideas and make you think critically.
So it's not just about taking in information, it's about really thinking about it, questioning it, and forming your own conclusion.
Right. And remember, the best investors, they're always learning. The market's always changing. So you have to stay curious and be ready to adapt.
This deep dive has been fantastic. I feel like I've learned so much about market crises and how to handle them strategically. Any final thoughts you want to leave our listeners with?
Just this market downturns are tough,
Yeah.
but they can also be really rewarding for those who can stay calm, keep a long-term view, and never stop learning. Don't let fear stop you. Use it to make smarter decisions.
I love that turn fear into fuel. So, to all our listeners out there, remember market crises aren't the end of the world. They're just a new chapter in your investing story. Stay informed, stay strategic, and stay positive. Until next time, happy investing.